Hello, everyone, and welcome to Financial Accounting. Today, we will look at managing cash flows. If you haven't had a chance to watch the videos about the statement of cash flows, including direct versus indirect methods, I'm posting the links in the description of this video. Now, let's look at a cash budget. A cash budget is a primary tool that management uses to anticipate and shape future cash flows. A cash budget is a forecast of future cash receipts and payments. It is not the same as a statement of cash flows and not a report usually distributed outside of the organization. It is instead a tool for internal management. Cash budgets are used by management to plan and forecast future cash inflows and determine whether there may be potential cash shortages to be managed. A cash budget is considered one of the most helpful accounting reports. A cash budget is similar to a statement of cash flows in many ways. However, the budget shows the results expected in future accounting periods rather than those achieved in the past. In addition, the cash budget is more detailed and usually shows expected cash flows month by month. It is also common to show expected cash flows separately for every department within the organization. Cash budgets serve many purposes. Among the most important are assisting managers in planning and coordinating their activities in advance, providing managers with advance notice of the resources at their disposal and the results they expected to achieve, providing targets helpful to evaluate organizations' performance, providing advance warnings of potential cash shortages. There are several things management can do to manage cash flows, such as increase collection on accounts receivable, keep inventory low, delay payment of liabilities, plan the timing of significant expenditures, and invest idle cash. What priority should managers give to increasing cash flows? First, it is essential to remember that creditors and investors look to a company's cash flows to protect their investment and provide future returns. Further trends in key cash flows, such as from operations and free cash flow, affect a company's credit rating, stock price, and access to additional investment capital. For these reasons, management is under constant pressure to improve the critical cash flow measures. Sometimes the pressure to report higher cash flows in the current period may conflict with managers' long-run responsibilities. Let's look at short-term results versus long-term growth. Managers can improve short-term operating results at the expense of long-term growth. For example, reducing expenditures for developing new products may increase earnings and net cash flows in the current period. The problem, however, is that over time, this strategy may reduce the company's competitiveness and long-term profitability. Keep in mind that many of the most successful products took many years to develop and test before contributing positive cash flows to the company. But what if we need a one-time boost to cash flows? How can it be achieved? Some strategies can increase the net cash flows of the current period, but without having much effect on future cash flows. Examples include collecting receivables more quickly, reducing the size of inventory. We can use several strategies for permanent improvements in cash flow, which may improve cash flows in both the short and long term. These strategies are deferring income taxes, peak pricing, and developing an effective product mix. Let's take a closer look at each of these strategies. Deferring income taxes means using accounting methods for income tax purposes that legally delay the payment of income taxes. An example is using an accelerated depreciation method for income tax purposes. Deferring taxes may benefit a growing business every year. As a result, it is an effective and popular cash management strategy. Some businesses have more customers than they can handle, at least at particular times of the day or year. Peak pricing is a strategy of using sales prices to increase revenue and control goods and services when total demand exceeds supply or capacity. Businesses might charge a higher price during the peak periods of customer demand and a lower price during off-peak periods. For example, a resort hotel might charge a higher fee on weekends and holidays. Peak pricing has two related goals. First, it increases the seller's revenue during the periods of most significant demand. Second, as customers alter their purchasing practices, it shifts some of the demand to off-peak periods when the business can provide better service to additional customers. Peak pricing may make goods and services available to customers who otherwise could not afford them. Also, peak pricing may prevent systems from becoming so overloaded that they cannot function. Peak pricing is not always appropriate. For example, we wouldn't expect hospitals or physicians to raise their prices during epidemics or natural disasters. The alternative to peak pricing is a single price all the time. Another tool for increasing revenue and cash receipts is the mix of products offered for sale. The dual purpose of compelling products mix are to first increase total sales and to increase gross margins, that is, the excess of the selling price over the cost of the product. Note that some products complement one another, which means that the customer who buys one product may purchase the other. Examples of complementary products include French fries at a hamburger restaurant, snacks at the movie theater, and a car wash connected to a gas station. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.